We'll go to the markets. Got a little bit of work to do here at 12 noon in the East because we are red across the board. The Russell is today's biggest decliner out of the majors. It is the NASDAQ. Underwhelming. That's what they're saying about Netflix and the results. The stock's down a bunch. We'll take a look. So they had the Brazilian tax dispute, which is one of the issues. Core margins were above estimates. Record high engagement and viewership. They're all in on leveraging AI, they say, in their note to shareholders. So I'll go to a shareholder. Joe Terranova, sitting next to me now. You buying this dip? What do you do?
All right, so here's the challenge with the stock. Fundamentally, when you hear the report, they hit on all of the metrics that you wanted to hear. We talked yesterday. I wanted to know, what's the plan with AI? Is it going to have the ability to reduce the spend on content, to lift margins? We talked about engagement, global engagement, needing to improve. It did that as well. Then you're throwing the curveball with Brazilian tax dispute. That curveball does not create the environment where you have the catalyst that was needed. We've talked about how the stock since June 30th really has been in a consolidation phase.
Let's show it, because it was after we at periods of time on this program, I have said something to the effect that this was one of the most, if not the most impressive stock in the market for a period of time.
Yes.
It did not go down, okay? I'm not talking about when it went from 700 to 400.
Right.
I'm talking about the resurgence that the stock had. Build it out further, and you'll see the run that I'm talking about, because it was an incredible stock. Even further, it was an incredible stock, which we talked about almost every day because so many people decided they were going to buy it on this program. And then it had this, there you go. And then it was, look at that move. I mean, it was pretty incredible. From that big drop down to that big run up, and then that sideways move more recently. Let's look at that now, as Joe was just talking about. Sorry, I just want to give some context for our viewers to understand the full story.
You have to tell the story of this stock because the journey has been remarkable. And up until June, the stock after today, it's not, but prior to today, it was outperforming the rest of the Mag 7. You needed a catalyst to get you out of the consolidation phase. You don't get that after yesterday's report. So now you ask the question, what do you do with the stock? Okay, here's the context that I'm working with, and I think Steven Surratt, you could respect this. The Joe T ETF takes a position in April of 2024, takes a position at 550. Okay, you could do the math, you could see what the gain is there. 1 month later, I take a personal position at 650. You could say that doesn't matter to where it is today, but it does because it gives me a degree of flexibility in terms of my positioning. What am I looking at? I am looking at the response to the 200-day moving average, which sits at 1113. It's the yellow line on the chart that we're showing. Earlier this morning, the stock went down to 1114. That's probably too perfect, Scott, that it held there. Probably too perfect. So what I am going to do over the coming days is I am going to see the reaction to this 200-day moving average. And despite what I might think fundamentally about the market, it is very clear to me right now that the market is working off some of the speculative excesses, and it's working off what has been a really strong year for momentum. And Netflix checks the box in terms of momentum. So in the next couple of days, I will reduce my personal holdings if this stock does not recover swiftly back towards 1150. If it stays here, kind of wallowing around 1100, 11 and a quarter, I'm overexposed at that point because I own it in Joe T, and I've actually owned this, as I've said, since May of 24 personally as well.
All right, so the street is trying to figure out where it wants to be on this name. JPM goes to 1275 from 1300. They're neutral. Wells goes to 1520 from 1560. They obviously still like it. They're overweight. UBS, they raised their target to 1495 from 1450, and they say you should buy it. Weiss, you also own it. What do you want to do with it?
First of all, I'm going to ignore those. Those price targets, they sound like big numbers.
That's fine.
But the moves are insignificant. I'm staying with it. The way Joe manages money is a little differently. It's a momentum-based model. He's very clear about that. I'm bottoms-up fundamental. And what I see here is a company that I believe delivered in the quarter, and they still have an amazing amount of levers to pull. Those include price increases. We saw Max increase their prices. They are still the most used streaming service. So for as long as I've owned Netflix, and I was out for a period of time a few years ago, every quarter is a roller coaster. Even when they report good numbers, you could see a 10% collapse in the stock. And bad numbers, 10% collapse. Good numbers, better, 10% upside. So we're seeing more of the same of that. And if you've gotten out of it because of this, or because it's hit, the 200-day and gone through it, You've made a mistake. So the bottom line is they're a market leader, they're a unique business, and I think there should be a premium for that, as there is, and the growth is still there.
Like, look at the prior. Oh, we just pulled it away. Pull that back, guys. Throw the other chart that you just had up. I was literally just gonna reference. I mean, you see the prior peak, and then you're feeling bad about the position that you have at that moment, and then look at the run. Speaking to the point, I mean, this is a stock where it's had a lot of momentum on either side of the ledger, up or down, has been hard to go against, right? Until it has settled in one direction or another.